The Fed is about to lower the rates again, and here in this video I'm gonna explain why and when is the next Fed cuts are coming. So if you're ready, let's just dive in. So the last time the Federal Reserve lowered the rates, we know that the stock market literally skyrocketed to the roof. The S&P 500 started growing, every other stock out there, especially when we talk about the tech stocks, because tech stocks have the biggest influence whenever we have the Fed lowering interest rates, simply because lowering interest rate is going to make their future cash flow much more valuable. But it's not just about the future cash flow, it's just about those companies being able to borrow money at a cheaper price and invest in new projects. And whenever you have more money flowing into your balance sheets, you can just show better quarterly reports every single quarter, and that will, on paper at least, make your company much more valuable, which will drive more investors, which means that your stock price is going to shoot in the stock market. And that's why investors, companies, literally everybody in the market just loves whenever interest rates are actually lowered down. Of course, on the other side, we always have to care about inflation. That is another important thing, because when inflation gets out of hand, I don't care how much you lower down interest rates. At the end of the day, it is not going to help anybody. And that's why we have to carefully watch when the next cut rates are coming. And that's very good news for you as well if you're investing in the stock market, if you have stock in the stock market, if you just started investing in the stock market, because as we know that the last 2 or 3 years were catastrophic for the market since I would say like January 2022. But now we are going to have most likely another wave of stocks just going to the roof. If you haven't invested the last 2 years, well, don't worry, you haven't really missed that much. But if you're starting to invest right now, then you are like about to invest just when people started investing back in 2020. Now, I'm not saying that interest rates will be lowered down that much, but at the end of the day, lower interest rates is far better than what we have seen the last 2 years. Now, if you take a look at the S&P 500, you can clearly see that the last cuts literally shot the market to the roof. And this is just the beginning, because if things continue the way they are now, if the news that the Fed will actually lower rates again, then when we can expect from the market, especially just the S&P 500, that it is going to grow farther. And if you are just investing in the S&P 500 and not investing in any other stock, you're already a winner in this economy. You're already a winner in this market, because a lot of people are really bad at picking up individual stocks. Of course, you can make far more money if you're actually good at picking individual stocks. But if you are not even good at picking individual stocks and you just go with the rest of the market, literally just invest in the entire market, you'll still end up going to win and make pretty good returns when interest rates are low. So the question that we want to actually answer in this video is that, will the Fed cut interest rates again this year? Now, there are two opinions. Some people on one side are saying that, yes, the Fed must cut interest rates in order to prevent the economy from falling into a recession. But on the other side, we have really people who are making bold claims that it is not in the best interest of the US economy to cut interest rates, because we still have to deal with inflation. It's not necessary for the Fed to actually cut interest rates, and the economy won't be much affected if we cut the interest rate or not. Of course, it is going to have massive influence, but maybe the priority of the Fed at this point might be, yes, we had this cut in September 2024, but maybe the next cut might be in 2025 and not this year. But what I'm about to share with you points out to the fact that the Fed might actually do that this November or probably December, right before the new year. Now, in order to find out whether the Fed is going to cut interest rates, there are two things that we have to take a look at. First of all is inflation and jobs. If these two reports indicate to the fact that it actually gives a signal to the Fed that it is time to cut the rates, then the Fed will most likely cut the rates. Because anybody, doesn't matter whether we are talking about Wall Street, whether we are talking about any other professional investors, or even world central banks all across the globe that are watching the United States, that are watching the Fed. You have to understand that the Fed isn't just having influence over the US economy or the US stock market. It is having influence all around the world. A cheaper dollar, a cheaper cost of borrowing the dollar is going to have massive influence all across the globe because it impacts the bond market, for example, in the United States. And a lot of other countries from across the globe take their investments, their savings, their emergency funds, and they just buy US government bonds. These are the most safe government bonds in the world, and that's why it's very important to follow very carefully, and that's why we have so much hype around the fact what the Federal Reserve is going to do next. So if you take a look at the inflation report, the latest inflation report that we got was pretty positive, I would say. I wasn't really expecting it because it kind of brings down the inflation for the last 12 months at around 2.2%. And that is the inflation target that the Federal Reserve always targets. Of course, the target is to keep it literally 2%, but that's impossible because the market fluctuates. So if it's anything between 1.8% to something between 2.2 or 2.3%, I think the Fed considers that as a success because I don't know how you can possibly manage prices and manage the economy in such a way where inflation at the end of the day is going to end up at around exactly 2%. So the fact that we got the news that we got the report from August and it indicates the fact that inflation has lowered down and is going to bring the annual inflation at around 2.2%, that is a fantastic news to the Fed. And that's a clear message to the Fed that it's over. We are over inflation. Don't worry about it anymore. You can safely lower down interest rates. Now, the Fed isn't solely going to lower down interest rate just because we have fixed inflation to a certain extent. Because the job of the Fed isn't just to lower down inflation. The job of the Fed is that the economy grows at a stable growth rate. So on the other side, if there is no risk of a recession, I would say that the Fed wouldn't rush to cut interest rates because why would we cut interest rates and just reverse engineer what we have actually worked the last 2 years? Like if you take a look at the last 2 years, just count the number of bankruptcies that we have in the last 2 years. There were like numerous numbers of bankruptcies. And I'm not even talking about the fact that we had even bank failures. Now, you see, bank failures were also caused as a result of the Federal Reserve hiking interest rates. And bank failures are much more dangerous than just another tech company going bankrupt. I'm not saying that it is great that some company out there or some business out there actually went bankrupt, but you have to understand the difference. Because when a bank actually goes bankrupt and it files for bankruptcy, people who keep their investments, who keep their money in a bank, they will lose their money as well. Of course, in the case of, for example, SVB, the government stepped in and ensured that no one is going to lose their money. But think about the psychological damage that it does to the banking industry, where people suddenly will be afraid to keep their investments, or I would say their savings in the bank, and everybody will rush to the bank to withdraw their savings before their bank goes bankrupt as well. And if you kind of go back in the timeline to 1920s, you will realize that the first sign or what really caused the Great Depression of 1929 that lasted over a decade was literally a banking crisis, where one bank after another started to fail, and that caused a domino effect that led to the Great Depression of 1929. So if you take a look at the annual data of inflation, the days of high inflation are over, where we had like an over 8%. I think it was more than 8%. I'm not really sure exactly, but I think it was like 9.3% or something like that. And I guess it really depends on how you count inflation, because some people would count, for example, just the CPI, or other people would include their maybe energy and other things. And that's why this number could actually fluctuate. And it's so easy to manipulate the numbers when we talk about the statistics. And that's why it's extremely important you get deep dive into the details and realize how exactly they counted inflation. So, but anything between 8 to 10% is already too high. I wouldn't say that 8% is exactly as 10%, but 8% and 9.3%, both of these numbers signals to the world or the economy that we are having too high of an inflation that must be fixed as soon as possible. But of course, in 2024, we're expected to have something 2.9%. And I think this is an old estimation, and the new estimations or the forecast would be something probably like 2.5% and closer to that. And that's a very good sign to the economy. And the possible forecast that we have at this point is that for the next 3, 4, probably 5 years, inflation is going to stabilize at around 2%, which means that it gives the Fed the ability to cut interest rates. Now, the main question isn't that will the Fed cut interest rates or not? The question is that when will the Fed cut interest rates? Because if cutting interest rates is going to happen this year, is going to happen before the new year, then we can expect another stock market rally, which is very good news for investors and the people who are in the market. So let's take a look at the other side of the equation, which is the jobs market. Now, the jobs market is where the bad news actually starts, because if inflation has been defeated because of high interest rates, jobs market have been suffering. Because if you take a look at the data, for example, we have the data for August, which is the latest data. We had an expectation or a forecast that 161,000 jobs will be added. But at the end of the day, this target was missed. And guess how many jobs we actually added? 142,000. Now, that might not seem like a big deal, but if you kind of go back and take a look at the data for July, for June, May, April, you will realize that we literally miss the data or miss the forecast every single month. So the forecast for July, for example, was 114,000. No, this is the number of jobs that was added. The forecast was 175,000 jobs. And overall, if you take a look within 12 months, something between August of 2023 to August 2024, there has been a forecast of around 3 million jobs to be added, but that target was missed by over 800,000 jobs. That's a clear signal to the Fed that we might be on the brink of a recession because companies are afraid to hire. Companies don't have the money to hire. Companies don't want to invest in new projects in order to hire more people. Companies are not certain about the future. So we want to actually lower down the rates in order for the economy not to fall into a recession. And I think that is probably the main reason that the Fed actually lowered the rates in September. So that actually led us to ask ourselves the next question. When exactly is going to be the next meeting of the Fed? Now, we have 2 more meetings left for this year. That is November and that is December. And I think, but the question that we want to actually include within this question is that are we going to have another inflation report and a job report before these 2 dates? Because based on those 2 reports, it will signal to the Fed whether it's time to cut the rates again. Now, of course, we have 2 more reports that are coming, which is in November and December, and they will tell us about the state of the inflation. And I think we don't have to worry about this because this is going to be something between This is going to indicate that the annual inflation will be around 2.5%, and that's something that the Fed will just absolutely love because it will fulfill their mission that they have been working towards for the last 2 years or so. But what is important is that we are going to have another job report that is going to come in October and November, and these two reports are going to tell us about the state of the economy and whether the Fed is going to lower interest rates. And based on what I have seen over the last year or so, that we have missed every single forecast, it is very likely that the Fed is going to cut interest rates because it wants to, let's say, start the next year with something I would call a boost within the economy, a trust and a confidence that companies will start actually investing more in order to fix that problem. Because if the economy actually falls into a recession and we still keep missing every single target, every single forecast about the number of jobs added to the economy, it is very likely that the economy might fall into a recession. And if it falls into a recession, then cutting the rates by another 0.5% wouldn't really make a difference. And the Fed might actually take extreme measures of cutting the rates to 2%, 1.5%. And that's something I don't think the Fed is willing to do, or I don't think the Fed is actually planning to do, because that could actually, again, spike inflation out of control. So the Fed is most likely going to cut interest rates because of the jobs reports that is leading the economy to fall into a recession. Of course, the Fed can actually prevent that by cutting the rates in the next 2 months probably. And that is very good news for you. So if you're investing in the stock market, if you are actually holding some tech stocks, if you're even holding the S&P 500, you can expect that the next 3-4 months or the next 6 months are going to be really great for the stock market. That's it for today. Thanks for watching, and I will see you in the next one.